So if you've been paying any attention at all to personal finance lately, you've probably noticed there's been, well, a seismic shift.
Hmm.
This kind of sophisticated investment management, the type that used to be only for the ultra wealthy, is now, on an app on your phone. It's really democratizing wealth management.
It absolutely is. And today, that's what we're diving into, these automated investment platforms, the so-called Robo Advisors.
Right.
And the mission here is really to figure out their true value. I mean, are they the future of financial freedom for everyone, or do they have hidden caveats, things you need to watch out for?
Okay, let's unpack that. For anyone who's heard the term but isn't sure about the mechanics, how does a piece of software actually manage a complex portfolio so cheaply?
Well, it really boils down to two things: algorithms and low-cost ETFs, or exchange-traded funds.
Okay.
So the robo-advisor is a digital service, and it uses these proprietary algorithms to automate everything. Instead of picking individual stocks, it just builds you a portfolio using these diversified low-cost ETFs.
So that's collections of stocks, bonds, cash, that sort of thing.
Exactly. But what's fascinating here is the core psychological goal.
Yes.
The entire system is built to eliminate emotional decision-making. When the market gets shaky and your gut tells you to panic sell,
Which it always does.
it always does. The algorithm acts like a digital seatbelt. It just forces you to stick to your long-term plan and avoids those biases that cost investors so much money.
And for the user, the process is, it's remarkably simple. You just tell it your goals, your risk tolerance, your time horizon, and the algorithm handles the rest.
And the rest is continuous. It's not a one-time thing. The automation handles portfolio construction, sure,
Hmm?
but also ongoing management. We're talking automated rebalancing, instant dividend reinvestment,
Keeping your money working, always.
always. Platforms like Betterment and Wealthfront, they're built entirely on this set it and forget it idea.
Okay, so this brings us to the big advantages, especially for, beginners or someone who's really cost conscious. The accessibility seems huge.
It is. Many have zero or very low account minimums.
And the cost efficiency is just transformative, isn't it?
It really is. A robo-advisor might charge, say, 0.25% to 0.50% of your assets per year. Now, compare that to a traditional advisor who might charge 1% to 2% or even more.
That difference adds up fast.
Over 30 years, that small difference in fees could cost you over 20% of your portfolio's total potential value. It's a massive drag on your returns.
And it's not just the fees, it's the strategy behind it. I hear the term modern portfolio theory a lot with these models.
Correct. Modern portfolio theory, MPT, is the mathematical framework for it. It's all about maximizing returns for a given level of risk through smart diversification. And the algorithms also handle really sophisticated things like automated tax loss harvesting.
And for the listener, tax loss harvesting is what exactly?
It's basically a highly efficient tax-saving strategy. When an investment loses value, the system sells it to harvest that loss, which can offset capital gains you have elsewhere. Then it buys a very similar fund to keep your allocation on track. It's complex to do by yourself, but it's critical for maximizing your after-tax returns.
Okay, we've covered the incredible efficiency, but it also sounds a bit like a one-size-fits-most approach. Where does that efficiency start to break down?
That's the perfect way to put it. That's where the limitations really start to show up. They fall short on personalization. When you have a genuinely complex situation like unique tax needs, business ownership, stuff like that, the models are just too generalized.
And you're stuck with their menu of ETFs, right? If you
Yeah.
want to invest in individual stocks or alternatives like real estate, you're usually out of luck.
Yeah, you are. And beyond the portfolio itself, I think the most cited drawback is the lack of human counsel. An algorithm can rebalance your assets, sure, but it can't give you advice on estate planning or, maybe most importantly, talk you off the ledge when the market crashes 30%.
So for a lot of people, the answer might be somewhere in the middle, the hybrid solution.
Exactly. Hybrid robo-advisors. They combine all that great automation with access to an actual human advisor, usually by phone or video. They bridge that gap, but, that human element usually means higher fees or a higher minimum balance.
So to sum it up for someone trying to decide, a pure robo-advisor seems like a great fit for beginners, hands-off investors, anyone who really prioritizes low fees and convenience.
For sure. But the human or hybrid option is probably better for investors with more complex finances, or people who just know they need comprehensive financial planning beyond just investing. And when you're choosing, you have to compare not just the advisory fee, but also the fees of the underlying ETFs.
Right, and make sure they offer the account types you need, like an IRA or Roth IRA.
Don't forget that.
So it's clear robo-advisors have totally revolutionized personal finance. They've provided this incredibly accessible, cost-effective tool for building wealth.
They have. But here's the final thought I'd leave you with. While past performance never guarantees future results, the ultimate factor here, it's one the algorithms can't measure. It's behavioral. The true value for you really comes down to assessing if your own personality requires that human connection to stop you from making a bad decision during the next inevitable market downturn.